Most people believe that buying a home is the ultimate sign of financial maturity. They call it the American dream. They tell you that rent is throwing money away, and that a mortgage is just a forced savings account. But if you look at the math, the numbers tell a very different, much more cynical story. The truth is that your house is not an investment in the way a business or a stock portfolio is. It is a wood and brick subscription service that requires a constant sacrifice of your liquidity. According to data from the Federal Reserve, the average person spends about 30% of their gross income on housing. When you sign a 30-year mortgage for $500,000 at a 7% interest rate, you are not actually buying a $500,000 house. By the time you make your final payment, you will have handed over more than $1.2 million to the bank. That is $700,000 in interest alone. You have effectively bought one house for yourself and nearly 1.5 houses for the bank owners. You are working 40 hours a week, but 15 of those hours belong to the bank executive's yacht fund. And it gets worse when you look at how that interest is structured. Banks use something called an amortization schedule. In the first 10 years of your loan, the vast majority of your monthly payment goes toward interest, not the principal. You are paying the bank their profit up front while you take on all the risk of the property value dropping. You do not truly start owning your home until the final decade of the loan. Until then, you are just a highly glorified tenant of the bank. Then there are the hidden leaks that the real estate agents never mention in their glossy brochures. Property taxes are a permanent rent you pay to the government. Even if you pay off your mortgage entirely, you never truly own your land. If you stop paying your property taxes, the government will take your home. This means your ownership is conditional. On top of that, you have homeowners insurance and maintenance. Most financial experts suggest budgeting 1% of the home value every year for repairs. On a $500,000 home, that is $5,000 a year just to keep the roof from leaking and the furnace from exploding. But there is a new player in the game that the average homebuyer does not see. Institutional investors like BlackRock and State Street have started buying up single-family homes by the thousands. They are not looking for a place to live. They are looking for a yield. When a multi-billion-dollar corporation competes with a young couple for the same 3-bedroom house, the math shifts. These corporations have access to nearly free capital from the debt markets, allowing them to outbid families who are stuck with 7% mortgage rates. This creates a permanent floor for housing prices that has nothing to do with local wages. According to a report by MetLife Investment Management, institutional investors could own 40% of all single-family rental homes in the United States by the year 2030. You are not just fighting inflation, you are fighting the largest pools of capital in human history. One viewer recently commented that in cities like Los Angeles or Manila, renting is actually more expensive than buying, but the hidden math suggests otherwise. When you rent, the rent is the maximum you will pay for housing that month. When you buy, your mortgage is the absolute minimum you will pay. When you factor in the opportunity cost, the math becomes even more brutal. If you took that $50,000 down payment and the extra $3,000 a month in taxes and maintenance and put it into an index fund averaging 8% annually, you would likely end up with millions more in liquid wealth than you would ever get from the appreciation of a single-family home. The real estate market does not grow as fast as the productive economy. Your house might go up in value, but so does every other house in your neighborhood. Unless you plan to sell your home and move into a tent, that appreciation is just paper wealth you can never actually spend without going back into debt. Next, we need to talk about the things people buy when they stop trusting the government. Gold and Bitcoin. Gold and Bitcoin. These are often grouped together as hedges against inflation, but they are governed by very different mathematical laws. To understand why anyone cares about gold in 2026, you have to understand what happened in August of 1971. Before that date, the United States dollar was backed by gold. You could theoretically walk into a bank and exchange your paper bills for a fixed amount of the yellow metal. But President Richard Nixon changed the world forever when he ended the convertibility of the dollar to gold. This was the birth of the pure fiat era. From that moment on, money was no longer a claim on a physical asset. It was a claim on the faith and credit of the government. Since 1971, the total money supply has exploded, and the value of a single dollar has collapsed by over 85%. This is why gold bugs are so obsessed. One of our viewers pointed out that gold has increased 749% since the year 2000. But gold is not an investment in the sense that it grows. Gold is just a constant. An ounce of gold bought a high-quality suit in the time of the Roman Empire, and an ounce of gold buys a high-quality suit today. It does not create wealth. It only preserves it against the systemic decay of the currency. Gold is essentially a bet on the failure of the system. It is a fire extinguisher. You are glad to have it when the kitchen is on fire, but you do not build your entire house out of fire extinguishers. Then there is the digital gold. Bitcoin. A viewer named Mitki02 made an excellent point. Volatility and risk are not the same thing. This is a distinction that the traditional financial media gets wrong every single day. Volatility is how much the price bounces around. Risk is the permanent loss of capital. Bitcoin is incredibly volatile. It can drop 50% in a month and then double in the next. But for those who understand the hidden math of scarcity, the risk profile looks different. Unlike the United States dollar, which can be printed in infinite quantities by the Federal Reserve, there will only ever be 21 million Bitcoin. This is a mathematical certainty written into the code. While the dollar has lost nearly all its purchasing power since 1971, Bitcoin operates on an inflation schedule that gets cut in half every 4 years through a process called the halving. However, there is a trap here. Crypto is not a monolith. There is a massive difference between Bitcoin and the thousands of speculative tokens that pop up every day. Most of these tokens are what we call zero-sum games. They do not solve problems, they only create hype. As one viewer noted, there are zero safety nets. If you lose your keys or get scammed, your money is gone forever. The math of crypto is unforgiving. It rewards the disciplined and destroys the gamblers who do not understand the learning curve. Now we move to the most dangerous lie in finance, the idea that cash is safe. We have been taught from childhood that saving money is a virtue. We put it in a savings account, look at the balance, and feel secure. But cash is not a store of value. It is a melting ice cube. The government tells you that inflation is running at 3 or 4%. But anyone who has been to a grocery store or tried to buy a used car lately knows that the math does not add up. This brings us to a concept called the Cantillon Effect. Named after the 18th century economist Richard Cantillon, this theory explains that when a central bank prints new money, it does not enter the economy evenly. The people closest to the money printer, the large banks, the government contractors, and the ultra-wealthy, get the new money first. They get to spend it before prices have risen. By the time that new money trickles down to you in the form of a small raise or a stimulus check, the prices of milk, eggs, and rent have already been bid up by the people who got the money first. In other words, inflation is a silent transfer of wealth from the bottom of the pyramid to the top. It is a tax on the poor and the middle class who hold their wealth in cash. If you have $100,000 in a savings account earning 0.5% interest, while real-world inflation is 10%, you are losing $9,500 of purchasing power every single year. You did not spend the money, but your ability to buy things with that money vanished. This is a hidden tax that requires no legislation and no vote. It is the systemic erosion of your labor. One viewer argued that cash is king because it provides liquidity during a crash. They are right, but only if they use that cash to buy assets when they are cheap. If you hold cash for 10 years, waiting for a crash that never comes, you have committed financial suicide by 1,000 cuts. You have chosen the certainty of losing to inflation over the possibility of market volatility. The hidden math of the banking system is designed to keep you in this trap. Banks take your cash, pay you almost nothing in interest, and then lend that same money back to your neighbor at 7% for a mortgage or 24% for a credit card. This is called fractional reserve banking. They only keep a tiny fraction of your money in the vault and lend out the rest, effectively creating money out of thin air. They are using your melting ice cube to build a freezer for themselves. Let us talk about cars. Most people see a car as a necessity, and the car companies see you as a recurring revenue stream. The moment you drive a new car off the lot, it loses approximately 20% of its value. According to data from Kelley Blue Book, the average new car price is now nearly $50,000. If you finance that car over 6 or 7 years, you are paying interest on an asset that is actively rotting away. But the real money for car companies is not in the metal and rubber. It is in the financing. Ford and General Motors are essentially giant banks that happen to sell cars on the side. They want you to focus on the monthly payment, not the total cost. They will offer you 84-month loans that keep you in debt for 7 years on an asset that will likely be worth less than half its value before the loan is paid off. And now, we have the subscription trap. Manufacturers are beginning to lock hardware features behind software paywalls. Some companies have tried to charge monthly fees for better acceleration or heated seats that are already physically in the car. The hidden math here is brilliant for the corporation and devastating for the consumer. They are turning a one-time purchase into a permanent expense, effectively renting you the features of a car you supposedly own. But there is a nuance here that our viewers pointed out. A car can be a capital asset. If you are a plumber and you buy a truck that allows you to carry your tools to 5 jobs a day, that truck is not a liability. It is a piece of industrial equipment. It has a return on investment. If that truck costs you $500 a month, but helps you generate $10,000 a month in revenue, the math works in your favor. The problem is when people confuse a luxury consumer good with a tool. Buying a $60,000 electric SUV to commute to an office job is not an investment. It is a lifestyle choice paid for with future labor. You are trading thousands of hours of your life for a seat made of vegan leather and a screen on the dashboard. The system wants you to stay in the cycle of upgrading your car every 3 years. They want you to focus on the monthly payment instead of the total cost of ownership. The hidden math shows that the average person could retire 5 to 10 years earlier if they simply drove used cars and invested the difference. If you manage to avoid the housing trap, the cash trap, and the car trap, you still have to face the invisible vampires, management fees, and the math of taxes. This is where the math of compound interest is turned against you by the very people who claim to be helping you. When you sit down with a financial advisor, they might suggest a managed mutual fund with a 1% annual fee. 1% sounds like nothing. It sounds like a fair price for professional guidance. But over a 40-year investing career, that 1% fee does not take 1% of your money. It takes nearly 1/3 of your total wealth. This is because fees are deducted every year, preventing that money from ever compounding. You are losing the growth on the money you paid in fees. According to a report by Vanguard, the difference between a fund charging 1% and an index fund charging 0.05% is staggering. If you start with $100,000 and it grows at 7% for 40 years, you would have about $1.5 million. But if you pay a 1% fee, you end up with only $1.06 million. You just paid the financial industry $440,000 for the privilege of them underperforming the market. Then there is the math of taxes. Most people work for an hourly wage or a salary. This is called ordinary income, and it is taxed at the highest rates. The system is designed to tax labor heavily and tax capital lightly. This brings us to the ultimate hidden math used by the ultra-wealthy. Buy, borrow, die. Instead of selling their stocks and paying capital gains tax, the wealthy take out low-interest loans against their stock portfolios. Debt is not taxable income. They use the borrowed money to fund their lifestyle, and because their assets grow faster than the interest on the loan, they effectively have infinite tax-free liquidity. When they die, their heirs receive the assets at a stepped-up basis, meaning the capital gains tax is wiped out completely. The math is not broken. It is working exactly as intended for those who understand how to use it. The financial industry is built on complexity because complexity justifies fees. If they told you the truth that you only need to buy low-cost index funds and minimize your taxable events, they would all be out of a job. They need you to believe that the market is a scary place that requires a man in a suit to navigate. In reality, the man in the suit is the one you should be most afraid of. So, what is the final equation? How do you use this hidden math to actually escape the system? It starts with realizing that everything you have been told about safety is a lie designed to keep capital flowing into the hands of the people who own the infrastructure. True financial intelligence is about managing the flow of value, not just stacking numbers. It is about understanding that your home is a liability until the day you sell it. It is about recognizing that gold is a hedge against chaos, but not an engine for growth. It is about knowing that Bitcoin is a bet on a new mathematical system of scarcity, but one that requires a stomach for extreme volatility. You win by becoming the owner of the freezer, not the person holding the melting ice cube. You win by minimizing your fees, ignoring the sirens of the car dealerships, and treating your house as a place to live rather than a lottery ticket. The math does not care about your feelings. It does not care about your desire for status or your need to feel safe. It only cares about where the value flows. According to the history of every fiat currency ever created, the end result is always the same. The numbers get bigger, but the value stays the same, or shrinks. Your job is not to win the game, because the game is rigged. Your job is to find the exit. The hidden math is your map. Whether you use it to find freedom or continue to follow the crowd into the meat grinder is entirely up to you. Wealth is not about how much you make. It is about how much you keep and how much that money works for you while you sleep. Everything else is just noise. The system is designed to keep you distracted by the price of eggs while they devalue the labor you spent to earn them. Don't be a victim of the math you refuse to learn.